Welcome to the deep dive. We're here to really extract those key insights, give you that shortcut to being genuinely well informed. And today, we are diving headfirst into mutual funds.
Yeah, the big one.
It really is. I mean, think about this. 56% of American households had money in mutual funds as of 2024. That's huge.
It touches so many lives.
Exactly. And with fewer traditional pensions around these days, understanding how things like mutual funds work, it's not just smart, it's pretty much essential for, your financial future. So our mission today is simple, really. By the end of this, you'll get what mutual funds are.
Uh-huh.
You'll see the different types, get a handle on how to actually start, and importantly, know what to look out for. Make those informed choices.
Right. Want to cut through the jargon, the noise.
Let's unpack it.
Definitely. We're aiming to give you that solid understanding, but, without drowning you in detail, we'll define them, talk about the pros like diversification, professional management.
Key advantages.
Exactly. Then we'll walk through the main types, the practical steps for you to invest, and crucially, the risks and things you really need to consider. It's about going beyond just knowing the definition, right? It's about understanding how you can use them.
Okay, so let's start there. The basics. For someone who maybe already knows a bit, what's that one core concept about mutual funds that maybe even experienced folks sometimes gloss over?
That's a great question. I think what often gets overlooked, even by people who've been investing a while, is just how much their structure relies on collective power. I mean, at their heart, mutual funds pool money, lots of it, from tons of individual investors like you.
Right, pooling resources.
Exactly. And that pool gives everyone access to two things they probably couldn't get alone: a really diversified portfolio of stocks, bonds, whatever, and professional management running it. This whole idea was formalized way back 1940s legislation, actually. It basically democratized investing, made it affordable for regular people.
Democratized investing. I like that. Leveraging scale, as you said.
Precisely. Leveraging scale.
And that leads right into the big advantages for our listeners considering these funds.
Yeah, the benefits are pretty clear right off the bat. First, diversification.
The big one.
Huge. Imagine trying to buy, 50 different stocks and bonds yourself. The research, the cost.
Nightmare.
Total nightmare. A mutual fund does that heavy lifting, spreads your money out. So if one area tanks, maybe another area does well and offsets it. It smooths out the ride.
Like a seatbelt for your portfolio?
Good analogy. Then you get professional management, experts watching the markets, making the calls, adjusting things for you.
Without paying billionaire fees.
Right. And finally, variety. There were over 7,000 U.S. mutual funds in 2023. Seriously, there's a fund for pretty much any goal or risk level you can think of.
Okay, 7,000 is a lot. But given that collective approach, how does buying a mutual fund actually feel different day to day compared to, say, trading Apple stock?
Critical difference. Stocks. You buy, you sell, prices bounce around all day long.
Yeah.
Exactly. Mutual funds, different ballgame. You place your order buy or sell through the fund company or your broker. But, and this is key, it usually only gets processed once a day after the market closes.
Okay.
Based on the fund's price at close, its net asset value, or NAV. So no reacting instantly to every little market blip.
Interesting. So it kind of encourages patience?
I think it does, yeah. It subtly pushes you towards a more long-term view, less impulse trading. It's probably why it works so well for things like retirement savings. Putting money aside from each paycheck, maybe getting that employer match in your 401k.
Makes total sense. It forces a bit of discipline. Okay, so 7,000 options. How do you even start sorting through them, aligning them with your goals? Let's get into the types.
Absolutely. Understanding the types is step one. We can group them by what they own. First up, equity funds, stock funds.
Investing in companies.
Right, publicly traded companies.
Yeah.
And here, the main ways you can slice and dice them are by market capitalization, that's company size. Large cap funds own the giants, Apple, Microsoft, generally more stable.
Okay.
Mid-cap funds are in that middle zone. Companies growing, maybe a balance of stability and potential. And small cap funds. Smaller companies, higher growth potential, usually.
But riskier.
But definitely higher risk, yeah. Then there's investment style. Growth funds, they're chasing potential big winners, focused on price going up.
Capital appreciation.
Exactly. Value funds look for bargains.
Yeah.
Stocks they think are underpriced, hoping the market catches on. And blend funds mix the two.
Got it. And geography matters too.
Big time. Domestic funds stick to U.S. companies. International funds go global. That adds diversification, but also, risks like currency swings, political stuff.
Right, different economies.
For sure. And you can even get region-specific funds, like just Europe or just Asia.
Okay, so equity funds cover the stock side, growth, potential volatility. What about the other side? Income, maybe more stability. That's
Um,
bond funds, right?
Precisely. Bond funds invest in debt, basically. Fixed income securities.
Yeah.
Think loans to corporations, governments, cities. Their main goal is usually generating regular income, plus adding some stability to your overall portfolio. They generally don't swing as wildly as stocks.
And how do you differentiate between bond funds?
Good question. Key things for you to look at are credit quality. Are they lending to super safe entities like the U.S. government, or riskier companies offering higher interest, junk bonds?
High yield, high risk.
You got it. And duration. This is a bit technical, but it tells you how sensitive the fund's price is likely to be if interest rates change. Longer duration means more sensitivity.
Okay, that's helpful. Now, what if someone wants, a bit of both, stocks and bonds, growth and income, all in one package?
That's where balanced funds come in, or hybrid
Yeah.
funds.
Ah, the hybrids.
Yeah. They're designed as a ready-made mix. Maybe 60% stocks, 40% bonds, something like that. Super convenient if you want a single, diversified solution. Take some guesswork out.
Simple solution. And what if you're just looking for somewhere really safe, low risk, maybe just to park cash for a bit, especially if interest rates are decent?
Then you're looking at money market funds. These hold very short-term, very safe debt. Think treasury bills, CDs. The goal is basically preserving your capital and keeping it liquid, easy to access, almost like a savings account, but sometimes with better yields, especially, like you said, when rates are higher.
Good option for short-term cash.
Huh.
Okay, now let's hit two really popular ones, especially for long-term stuff like retirement. The set it and forget it options. Index funds and target date funds.
Oh yeah, these are massive. Index funds are passively managed. They don't try to beat the
They
market.
just track it.
Exactly. They aim to match a specific index, like the S&P 500. Because they're passive, their fees are typically much, much lower for you,
Lower fees, that's always good.
always. Then target date funds. These are built for a specific retirement year, say 2050. The cool thing is, they automatically change their mix of investments over time. They start aggressive, more stocks when you're young.
And get safer closer to retirement.
Precisely. More bonds, less risk as your target date gets nearer. Really hands-off. Super common in 401k plans.
Very clever. Beyond those big categories, are there more niche options? Specialty funds.
Oh, absolutely. Loads of them. If you have a specific interest, there's probably a fund. Sector funds focusing just on tech or healthcare, for example.
If you're bullish on one industry.
Right. Or SRI, ESG funds, socially responsible investing, or environmental social governance. They pick companies based on ethical criteria.
Investing with your values.
Exactly.
Yeah.
You've also got funds focused on real estate, maybe through REITs, or even commodity funds, tracking things like gold, oil, agriculture. It really shows how specific you can get.
Wow, the range is incredible.
Right.
So with all these different funds doing different things, how do we actually measure how well they're doing? You mentioned total return earlier.
Yeah, total return is the metric you want. It captures everything, both the change in the fund's share price, capital appreciation,
Price going.
and any income paid out to you, like dividends from stocks or interest from bonds. It wraps it all up into one percentage figure over a certain time. Gives you the full picture of the investment's actual performance.
Okay, makes sense. Total return. Got it. All right, we understand the what and the why. Let's get practical. Where do you, our listener, actually begin your own investing journey with mutual funds?
It really has to start with you. With understanding your situation, it sounds basic, maybe, but it's fundamental.
Weighing the groundwork.
Absolutely. Define your investment objectives. Why are you doing this? Saving for retirement, a house down payment, kids' education, just building wealth.
Knowing the why.
Knowing the why. Then, your time horizon. How long until you need the money? Years. Decades. That massively impacts how much risk you can take, which leads to risk tolerance. How much up and down can you stomach? Are you okay with volatility, hoping for higher returns? Or do you sleep better with a steadier, more conservative approach? Be honest with yourself.
Self-assessment time.
Totally. And finally, a hard look at your financial situation. Income, expenses, debts. What can you realistically, comfortably invest on a regular basis? This isn't about dreaming. It's about planning.
Right, setting that foundation. Once that's clear, then it's time to actually look at funds. How do you do that? What tools are there, and what key things should listeners be zeroing in on?
Okay, now you start digging. Use the tools on your brokerage's website, or check out reputable sites like Morningstar, Yahoo Finance. They often have screeners to filter funds.
Filters are useful.
Very. First, match the fund type and style to those objectives you just set. Growth,
Bro.
income, passive. active. But then, and listen closely here, expense ratios. This is so important. It's the annual fee the fund charges.
The cost of management?
Right. And it might look tiny, maybe 0.5%, 1%, easy to ignore, but the real impact over decades, it's enormous. That small percentage compounds against you. It can literally shave hundreds of thousands off your final nest egg. It's like a silent tax on your future wealth. You have to pay attention to it.
Wow, put like that. It's critical. So low expense ratios are key. What other fees should people watch out for?
Good question. Look out for loads. These are sales charges. Front end means you pay when you buy shares. Back end means you pay when you sell.
Ouch.
Yeah, honestly. For most people, just look for no-load funds. There are thousands of great ones. Why pay a sales charge if you don't have to?
Makes sense. Avoid the loads.
Definitely. Also check for little things like redemption fees if you sell too soon, or 12b-1 fees which cover marketing costs. And be aware of the minimum investment. Some funds need $1,000 or more to start, others maybe just $100.
Practicalities.
Yep. Also worth glancing at the fund manager's track record. Check the fund size, assets under management, or AUM. Bigger isn't always better, but large AUM often means it's well established. And consider liquidity. How easily can you sell? And finally, if it's not in a retirement account, think about tax efficiency. Some funds are managed to minimize taxable payouts.
Lots to consider on the fee and practical side. Okay, choices narrowed down. Next step, opening an account. What are the main types, especially those with tax benefits?
Right, the account itself matters a lot. You've got your standard taxable brokerage accounts, individual, joint, flexible, but you pay taxes on gains and income each year.
A default option.
Kinda. But the real power for long-term goals often lies in retirement accounts. Think Roth IRAs. Your money grows tax-free, and withdrawals in retirement are tax-free. Huge advantage.
Tax-free growth and withdrawal. Nice.
Or traditional IRAs and 401ks, where you might get a tax deduction now and the money grows tax-deferred until retirement.
Yeah.
The government basically gives you incentives to save long-term.
Leverage those tax advantages.
Absolutely. And for education, you have things like 529 plans, which also offer tax benefits. Using the right account structure can seriously boost your end results.
Okay, account open, fund chosen. How do you actually put the money in all at once, little by little?
You could do a lump sum if you have it, but a really common and often psychologically easier strategy is dollar cost averaging.
Dollar cost averaging, right?
Yeah, you invest a set amount, say $100 every month or every paycheck. Doesn't matter if the market is up or down.
Automatically.
Like often, yeah, you can set it up automatically. The beauty is when prices are low, your fixed amount buys more shares. When prices are high, it buys fewer. It averages out your purchase price over time, takes some of the timing guesswork out.
Smooths out the bumps.
Exactly. It's a great disciplined approach. And just remember, buy or sell, the order goes through at the end of day NAV price we talked about.
Okay, great strategies there. We've covered the upside, how to start, but we absolutely need to talk about the other side. The risks and the key things to keep watching. Because investing isn't just set it and forget it.
Unless it's maybe one of those target date funds, yeah.
Right, with that exception.
No, you're absolutely right. Ongoing attention is key. One big part is ongoing management and rebalancing. You need to check in on your investments periodically, see how they're doing relative to their goals or benchmarks.
Right.
And rebalancing. This feels weird to some people.
Selling winners, buying losers.
Kind of. If stocks have soared and now make up too much of your portfolio according to your plan, you sell some and buy more bonds or whatever is lagging to get back to your target mix. It seems counterintuitive, but it enforces discipline. It helps you systematically buy low and sell high, keeps your risk level in check, stops you from getting carried away by market euphoria or panic.
Smart discipline. What about broader risks?
Well, there's always market risk. The whole market can go down, pulling your fund with it. That's just part of investing in stocks or bonds. Can't avoid it entirely.
Unavoidable.
Then, especially for long-term folks, inflation risk. This is sneaky, but huge. If your investments earn 5%, but inflation eats away 3% of your purchasing power.
Your real return is only 2%.
Exactly. Your money isn't growing as much in real terms. You need returns that consistently beat inflation to actually increase your future spending power.
Yeah.
It forces you to ask, am I really getting ahead?
It's a crucial point.
Yeah.
What else?
Cash drag.
Yeah.
If a fund manager holds too much cash instead of investing it, it can drag down performance, especially when the market's rising. And fee drag, just hammering home that point again.
Fees matter.
They really do. That 1% fee on a 10% return means you get 9%. Calmed year after year, it's a massive difference. It pays to be fee conscious.
Okay, those are general risks. Are there risks specific to certain types of funds?
Oh, definitely. Bond funds have credit risk. the chance the borrower won't pay you back.
Default risk.
Right. Some funds, maybe small cap or emerging market funds, might have liquidity risk. The stuff they own might be hard to sell quickly without affecting the price.
Gotcha.
Sector funds are obviously vulnerable to downturns in that specific industry. Region-specific funds face risks tied to that area's economy or politics.
Right.
And international funds always carry currency risk. Changes in exchange rates can help or hurt your returns.
So know the specific risks of what you own.
Absolutely essential.
Okay, 2 quick clarifications we should probably recap. Actively managed versus passively managed funds, and the difference again between mutual funds and ETFs.
Good idea. So active versus passive. Active managers try to beat a benchmark index. They make buy-sell decisions. This usually means higher fees for their expertise.
Trying to outperform.
Right. Passive funds, like index funds, don't try to beat the market. They just aim to match its performance, usually much lower fees.
Match, not beat.
Yep. And mutual funds versus ETFs, exchange-traded funds. The big operational difference, as we touched on, is trading. Mutual funds price once a day at NAV. ETFs trade on stock exchanges all day long, like individual stocks.
Real-time trading for ETFs.
Exactly. That difference impacts how you might use them and maybe even your trading psychology.
Makes sense. And finally, if someone wants the absolute definitive nitty-gritty details on a specific fund, where do they look?
The prospectus. Always read the prospectus before investing.
Like official document?
It's legally required. It lays out everything. The fund's goals, its strategies, all the risks, every single fee, details about the managers. It's your ultimate guide. And this is printed on every single one. Remember the golden rule. Past performance does not guarantee future results. It shows you history, not the future.
Crucial disclaimer.
And tying this all together is asset allocation. Deciding how to split your money between different categories, stocks, bonds, cash, maybe real estate that's fundamental to building a portfolio that fits your specific needs and risk tolerance.
Okay, fantastic. So let's wrap up this deep dive. The big picture. Mutual funds are a really accessible way for you to get diversification and professional management. You can buy them through brokers or directly. But the key, the absolute key for you, our listener, is making choices that are informed based on your goals, your timeline, your comfort with risk, and being really aware of those details like fees and risks we talked about today.
Couldn't have said it better. And while hopefully this discussion gave you a really solid framework for a plan tailored specifically to you, talking to a qualified financial advisor is always a good step. Now, thinking about everything we've discussed, especially the long-term drag of fees and inflation, it leaves me with a question for you. Given how much those seemingly small percentages can impact your financial future decades down the line, how much time do you actually spend understanding the real cost of your investments? And are you really optimizing every single percentage point to make sure you reach your goals? Something to think about.